Welcome back, everybody. If you're new here, my name is Mike Moore. Today I'm going to be showing you my M1 Finance portfolio. But first, let me go over to our channel analytics and say thank you to all our new subscribers. Over the last couple weeks, we've received over 880 views and we've received over 80 subscribers. Our top video over the last 28 days is the video about passive income from YouTube. And last but not least, our real-time activity. Over the last 48 hours, we've received 194 views. So without further ado, let's get back into our M1 Finance portfolio and just give you a breakdown of where we're at, where we started at, and where we're headed. So as you can see here, we started off this account June 10th with a deposit of $100. My goal is to add $70 a day from my day job and then also add in all the passive income we make online into this portfolio. Last but not least, part of our passive income is from affiliate sales. We've had two people sign up under our link for M1 Finance, which has given them both $20 and given me $20 for each referral. So I really appreciate you guys who have signed up under my link. That's added $40 to this finance portfolio, which is amazing. I can't thank you guys enough for helping me out with all the views, the comments, the likes, everything, subscribing. You guys are the best. Don't forget to subscribe, hit that notification bell. We're going to be pumping out a lot of videos here and teaching you how to invest and how to increase your side hustle income. First, let's go down our list of ETFs that we've chosen for this fund. I wanted to really diversify and give ourselves the best chance for growth as well as get that dividend appreciation going on. What's really good about these first two is that they both pay dividends monthly, which is something I'm looking at. I'm looking at replacing my income in the future with dividend checks. So we wanted something that would be fairly consistent. We've loaded up on these two. And then to diversify, we've added in a couple of the Vanguard funds. We have their growth fund, the QQQ series, which is a very growth-oriented ETF. And then we have VYM, which is another dividend-oriented stock. Then to just really give us some broad diversification, we went with this Vanguard Total Stock Market, which has a ton of holdings. So if you're new to investing, this probably seems like a bunch of mumbo jumbo, but let me try and break it down a little bit easier for you. Basically, an ETF is just a holding of a bunch of stocks. A stock is essentially a piece of paper that you buy that gives you ownership rights to a certain company. And what's really cool is that these companies pay out dividends to their shareholders. A dividend is essentially a share of the profit the company makes. So if the company makes a couple million per year, a couple billion, they pay out a percentage of that to people who buy their shares. Hopefully I didn't make that too confusing. I'm going to be breaking down those concepts in future videos, but for now let's keep it simple and show you why I've picked these funds. So the first two, SPHD and DIA, I really like these because they pay those monthly dividends. First, let me break down SPHD. SPHD is Invesco's S&P 500 High Dividend Low Volatility ETF. They have over $3 billion under management, which is essentially how much people have invested into this ETF. So people believe in this ETF to the tune of about $3 billion. You can see the distribution yield, which is the dividend percentage. So for every dollar you put into this ETF, you get about 4% of that paid to you over the course of the year in terms of dividends. We scroll down here, you get to see the sectors that this ETF is in. It's pretty heavily weighted in the financial markets, the utilities and energy markets, and it has I was looking up here, it has over 51 holdings, and down here that shows you their top 10 holdings. The top one is Ford Motor Company. If you click here on View All, you can scroll down and see every single company that this ETF has purchased. The second one we've invested in is DIA, which is the Spider Dow Jones Industrial Average ETF. Let's scroll down here. Assets under management, they have $21 billion under management. It has a dividend yield of 2.1% for the year, and it has 31 holdings. Scroll down to the Top 10 sectors, it is pretty heavily weighted in industrials, technology, consumer, cyclicals, financials, and healthcare. The top 10 holdings, we've got Boeing, United Health, Home Depot, McDonald's, Goldman Sachs, Apple, Visa, 3M, Travelers, and Walt Disney. There's 51 holdings, I believe. No, I'm sorry, I said that wrong. 31 holdings. You can view them all here. So if you buy one of these, one share of this ETF, you get ownership of all these companies here. This is one of the ETFs I really like. I really suggest this one. It's got a bunch of solid companies in it. It's got a good dividend yield. The dividend pays every single month, and that's why I've picked this fund. So I'm gonna just break these down real quick. So let me keep going down the list. I've picked VIG, which is Vanguard's Dividend Appreciation ETF. This one is focused on dividend growth. It's a really popular ETF today. It has over 36 billion under management. Their distribution yield is about 1.76%, and they have over 186 holdings. So if you buy this ETF, you're getting the diversification of owning 186 different shares of stock. You can see here, over the last 5 years, they've averaged a 10.89% return, which is amazing. If you're investing, I suggest you look at ETFs that are in this kind of 8 to 12% range and up. You want something that's stable. You don't want to be going for these penny stocks or these crazy, outlandish investments. You want to be invested in safe, solid things that are going to pay you over time. They're going to continue to grow over time, and it's going to just compound and create wealth for you over the long run. So let's break down the sectors. This one's heavy into the industrial market. It's heavy into consumer cyclicals, technology, healthcare, and non-cyclical consumer. Top 10 holdings here. So my philosophy is that I want to own a broad share of the market, get good diversification, and get some good dividend growing, dividend paying stocks to help fund my account and fund my retirement in the future. With that being said, I also have chosen VUG, which is Vanguard's Growth Fund. The reason why I chose this is because so far these last three have been a little bit more of the first three are a bit more of those older, more steady companies. They're not so much heavy growth companies anymore. So we went with VUG, which is a bit of a large cap growth ETF. They have 42 billion assets under management. You can see the dividend yield is a lot lower. It's a 1.1%, but they have over 303 holdings as of right now. If you look at here, the reason why we went with this ETF, over the past 5 years, they're averaging closer to 12% compared to the last other couple ETFs, which were around 10, 12, I believe 10, exactly. So this one's a little bit of a higher growing. They don't have as much of that dividend, but when you're investing, you want to get a little bit of both. You want to have some of those older, more historic companies that have done well over time. And then you also want to invest into some newer, more growth-oriented companies that are really expanding and taking over big markets. Here we can go down. This one's heavily weighted in technology and consumer cyclicals. The top holding is Microsoft, Apple, Amazon, Facebook, Visa, MasterCard. So this one's heavily weighted into the technology market. It's going to give you a good exposure to all those new and growing technology companies. Next we have Invesco, symbol QQQ ETF. This is their fund which tracks the NASDAQ 100. We chose this fund for a couple different reasons. The main reason is the amazing growth that this fund has seen over the last 10 years. Over the last 5 years, this ETF has earned about 16.2% on average. If you look over here at the even longer range, it's earned almost close to 20%, which is really good for the amount of diversification that this ETF gives you. You can see it has a huge amount of people who have invested in it. It has over $75 billion under management right now. And if we scroll down, you can see that this one is heavily weighted technology and consumer cyclicals. So you're seeing a little bit of what we saw in the last one, which was the growth fund. They own a lot of the same: Microsoft, Amazon, Apple, Facebook, Pepsi, Comcast. Another great ETF for growth. And then to round off our portfolio, we've added these two very cheap ETFs. We've added Vanguard High Dividend Yield, so stock ticker VYM. You can see here they have 24 billion under management. The dividend yield on this is 3%, and they have 422 holdings, so huge diversification here. Let's look at the charts. On average, this one's a little bit lower than the others, but it's getting on average about 9% a year, which is still good. Like I said, you want to stay in that 8 to 12% range. And if you look over here at the 10-year chart, it's even better. It's at about 14.8% return. Let's scroll down to the sectors and holdings. You can see this one's a little bit more diversified. It's not heavily weighted into any one of these, and it has a large group of holdings, the top of which is Johnson & Johnson, JP Morgan, Exxon, Procter & Gamble, Pfizer, AT&T. All these are known to be good dividend paying stocks, and this is another one to just help round out our portfolio. And last but not least, just to make sure we get that ultimate diversification, VTI is a great stock to own. I've read a bunch about this ETF. This is Vanguard's total stock market ETF. It has a very low percent expense ratio, has over 120 billion in assets. This tells you that people trust this ETF. They really like having this in their portfolio, and I do too. You can look at the dividend yield is about 1.81%, and if you look here, this one blows all the other ones out of the water in terms of number of holdings. By buying one share of this ETF, you get a percentage of each of these holdings, so 3,566 companies. How cool is it that for $31.66, I get to buy a percentage of 3,566 different companies? That's amazing. That's what is going to help diversify your portfolio, give you long, steady growth. I want you guys to learn to stop chasing these offers that are too good to be true. People pitching these penny stocks, these day trading accounts, and all this stuff. It's too good to be true. If it's too good to be true, it is. It's so much smarter to invest in the long term. Trust me, guys. I've lost money buying and selling penny stocks and stuff like that when I was younger. I was stupid. I was dumb. I didn't know what I was doing. I've learned a lot. I've read a bunch of books about investing. I've broken it down. These are the ETFs that I really firmly believe in. And with that breakdown, you get a little bit more insight into the 7 selections that I've chosen. Hopefully that clears up why I've picked these ETFs and gives you guys a little bit better understanding of the market and how it works. What's really cool is that ETFs are kind of a new thing. If you look at VTI, which is one of the older ones, it was first started in 2001. So a lot of the older generation didn't have access to this great way of diversification and just overall investing. I really, really believe in investing in ETFs over in individual stocks. I think it's just a better play, smarter play, and it's going to work out better for you in the long run. If you guys have made it this far, that's amazing. I really appreciate it. If you haven't subscribed yet, please subscribe now. Hit the notification bell. Like, comment, subscribe. We'll see you guys on the next one.